the service. In IFRS 17 then we get some advice on combination of insurance contracts. Now let's start by talking about IFRS 4 here, and under IFRS 4 there was no specific requirements about the combination of insurance contracts. But IFRS 17 says, no, we should look perhaps at the commercial rationale for setting up a group of insurance contracts, and maybe we should combine those together. So if an entity might enter into a series of insurance contracts with the same or a related counterparty to achieve an overall economic effect, if we're going to get a genuine understanding of the business, then it may be necessary to combine the group or series of contracts together and analyse them in their entirety. And that would give us a better understanding. If, for example, an entity enters into two separate insurance contracts with the same counterparty at the same time with exactly opposite rights and obligations, well, it doesn't account for those contracts because the combined effect is that no rights and obligations exists. So taking that theoretical demonstration, we can see that by considering combinations of contracts, we get a better understanding of the commerciality of the contracts that we're seeing in the financial statements. Let's move on now to separating components from insurance contracts. And of course, insurance is quite unique. We have a transfer of significant risk and we have a lot of uncertainty with regard to that risk. Now, included within the insurance contract may be components that would be within the scope of another standard if they were in fact separate contracts. So to achieve a true and fair view of the financial reporting of all the components involved, we do have to separate certain things out from the insurance contract. So IFRS 17 says that there are three different kinds of components that have to be accounted for separately, and these are embedded derivatives, investment components, and promises to transfer distinct goods or distinct non-insurance services. So if the overall insurance contract contains any of those components, they must be separated out and accounted for separately. We'll look now at the level of aggregation of insurance contracts which is required by the standard. And at first glance this looks fairly straightforward. We say that an entity shall identify portfolios of insurance contracts, and a portfolio comprises contracts subject to similar risks and managed together. So for example, contracts within a product line would be expected to have similar risks and hence would be expected to be in the same portfolio if indeed they are managed together. And contracts in different product lines, for example, single premium fixed annuities compared with regular term life assurance, would not be expected to have similar risks and hence would be expected to be in different portfolios. However, on the next slide we'll take a look at the minimum portfolios that are required, and this may add some complexities to the basis on which we actually devise our portfolios of insurance contracts. So the standard says an entity shall divide a portfolio of insurance contracts issued into a minimum of three groups, and that's a group of contracts that are onerous at initial recognition, a group of contracts that at initial recognition have no significant possibility of becoming onerous subsequently, and a group of the remaining contracts. And within those groups, an entity shall not include contracts that are issued more than 1 year apart. Now notice that the grouping here is based upon the performance of the contract. Previously, under old standards, the company might have grouped portfolios together based upon risk, whereas this is grouping based upon performance. And of course, onerous contracts may be subject to different risks, and therefore the company may have to rethink its approach to portfolios of insurance contracts. Now, on a practical basis, it may not be necessary to assess the profitability of each insurance contract on initial recognition if an entity has reasonable and supportable information to conclude that each contract in the portfolio or group has the same profitability. So profitability of insurance contracts should be assessed individually at inception if the entity doesn't have such information, but need not be assessed at inception if the information actually exists. And an entity should assess the significance of the risk of contracts becoming onerous based on the likely changes in assumptions affecting contract profitability using